Superclusters is where we demystify the secrets, stories, and tactics behind the money that moves the venture capital world.
What do LPs expect at a venture capital firm's annual summit? What questions should you be asking your advisory committee? When should you be bringing these conversations up? Of course, we also talk about where do GPs spend a bulk of their conversations with LPs, and when do the most important conversations happen between an investor and their investor. This is our new series, LPAC, where we bring on previous guests on the podcast to answer your questions on how to build your venture fund. If you're a fund manager and need advice, you can submit your questions to me across all social media platforms, and maybe we'll have you on the podcast next. Today, we've got a friend of mine, as well as a good friend of the show, Adam Marchick at Akkadian, where he runs the Emerging Manager program, as well as one of our industry's most sought-after conferences, Raids. We unpack his story in our episode in Season 4, but for the purpose of today, we're going to borrow his brilliant insights. So, drumroll, Adam Marchick. One thing we were talking about earlier, right before we clicked record, was stories. And you said something where I'm going to paraphrase, which is, it's free to tell a good story. And so, question for you, just riffing off of that part of the conversation, what are the elements? What is the anatomy of a good story?
The first is what you're trying to have come across,
Yeah.
right? A good story, you know how you repeat something 6 or 7 times in a good story or reinforce it.
Yeah.
So the first thing is knowing where you're going in a story versus, especially for an emerging manager, it's also raw. It's really easy to kind of meander. But I think it's around saying, here's what I'm trying to do. Here's the story and why it shows why I'm trying to do. And here's how I'm going to do more of it.
Yeah.
Right? And making sure the story has all of that within it.
And would you say that roughly should be the structure of an AGM? So for those listening and who are unfamiliar with AGM, annual general meeting, it's the annual meetings, annual summit that a lot of VCs host. Obviously, a lot of emerging managers don't have the budget to and the bandwidth to do so, but more often than not, as LPs, we do expect at some point in the lifetime of the fund, a repeatable kind of annual summit that we see. But to go back to it, would you say that structure of a story is how you would like to see the format of an AGM, or is it just purely story?
Very much so, because it's an emerging manager is figuring out their story. B, they might have learned some things in the last year that are changing the story. So understanding where you were and where you're going, we have to understand what your focus is before we get into the conversations, right? And I think if, for example, if you say you're very hands-on, the company story should talk about being hands-on.
Yeah.
Right. It should reinforce. So you need that entry, because a lot of times for a GP who, for an LP, they haven't heard the story in 9 months, or it's their junior person or other person that had to pitch in to come to the AGM. So too much familiarity too quickly can get the main headlines lost.
There's I want to say Mark Suster wrote this on both sides of the table. This is years ago, I would say probably, I don't know the actual date, but probably like 2016, 2017 or so, but a while back, where he talks about every time you have, and he talks actually about this with founders to VCs, right? But I think it equally applies from GPs to LPs, which is every time you have an opportunity to interact with an investor, your investor, either prospective and or current, you have to remind them why they love you. And I think it's a useful framing because LPs are generalist. Their job isn't just to focus on venture, and their job isn't to focus just on emerging managers, which is like venture itself is the smallest bucket of their allocation pool. Emerging managers out of venture is the smallest out of the smallest bucket out of their total allocation pool. And so just by time spent and energy spent and effort spent, it's not something that they think about, or the average LP thinks about all the time. So when they do show up to an AGM, it's important to rekindle that spark, if that makes sense.
And the nature of venture is changing. I think we're seeing companies that take in 10 billion of private capital before going public,
Yeah.
right? So the LP from the 80s said, like, hey, can't you go public on $10 million invested, right? So you have to kind of keep people in the loop of, is the market, it's changing. The venture market changes a lot more than the private credit market, for example.
How often would you say change happens in venture? And I think we probably go through a series of short sprints than like, there's constant change per se. But how often do you think the iterative cycle should be in venture?
Well, it feels really like every 10 years, there's a real change, where web, SaaS, AI are kind of the 2000, 2010, 2020.
Yeah.
Right. So it really isn't, every decade there's tectonic shift. Depending on where you're focused as a fund, there could be more major shifts and more often shifts. I think, for example, it just feels like there's a shift in defense tech in space, right? And it's really a 0 to 1 almost shift.
Yeah.
Where there used to be a space company, now there are space funds. So it really depends. Deep tech, similarly, where if you're in a more specialized market, the changes feel much broader. But I think from an allocator perspective, it's every decade.
Yeah. And I feel like, and obviously I haven't worked for that long. I am younger in the grander scheme of things. I'm Asian, so I will look like this for a very long time until I turn 60 years old, and I'll look like I'm 120. But on that note, say with AI, like I was definitely working by the time we kind of had the AI tectonic shift. It's something that everyone feels. It's not something that only VCs feel or only founders feel. Everyone is feeling that tectonic shift. And so when LPs are looking for clarity on, say, AI, right? We don't have to apply across the entire industry, but let's say for you, what is the kind of clarity you would like to know about the AI shift or like the defense tech or space tech shift when you do go to an AGM?
I want it rooted in business metrics, right? So it's okay to say, we feel like there's a shift going to happen, but these companies are still early, right? But when you understand the shift, like when SpaceX is at billions of revenue, Anduril's at billions of revenue, OpenAI is at billions of revenue, Anthropic's at billions of revenue, understanding billions of revenue shift in business metrics. That's the level at which LPs typically operate.
The fundamental metrics, the health of the portfolio as kind of time goes forward.
And that's also one thing that's hard is a lot of people say, hey, here's my overall revenue growth of my fund. Well, venture's made on the exception, right? So if each company is growing 20%, that's not an exciting portfolio. If 3 companies are growing 300%, that's an exciting portfolio. So there's a lot of nuance around trying to have aggregated data because that's what statistics say, and then making something that's complete but just not helpful, right?
Actually, on that note, curious for you, let's call it Adam's rule of thumb. For a 3-4 hour AGM, how many founders do you expect to see on stage?
I would hope to see 2 to 3.
Okay.
But again, this is one of the fun things, and I'll give a shout out to Doug Dyer, Chapter 1, right? That he is so good as a CFO. I'm happy to talk to him before I talk to Jeff, who's the founder of the firm.
Yeah.
Similarly, as a GP, if you're so good at storytelling, your story perhaps is about the company, perhaps is better than if the CEO just got up. Because the CEO needs to toe the party line, needs to talk about next quarter.
Yeah.
The GP can talk about the story around the entry, exit, the dynamics. So I would say, and that's also sometimes hard to do when the GP is in, the CEO is in the room.
Yeah.
Right. So I would not underweight your storytelling versus trying to have the company just tell it. Because when I was running a company, I had to talk about the go forward of my company.
Yeah.
Talking about the negative or the scary or the, press was that was not my job at an AGM, right?
That's a really good point. And so in many ways, when it comes to a founder going on stage, even before the founder goes on stage, to be fair, the GP can share, A, why did we invest in this company? B, why are we still excited about this company? C, what's going right? D, what's going wrong, or what are some of the risks that we might face in the next 18 months or so? And then after that, the founder kind of tells like, hey, here's the big vision. And, they go on their normal spiel. Is that a helpful framing for how a GP should talk about their portfolio company?
I think it is. It's tough to talk about risks with the founder in the room. And also maybe I would, you can kind of I would move the risks before the founder walks up.
Okay.
And then maybe say, hey, over the next 2 years, here are things she and I are thinking about.
Yeah.
Right.
That's a good point. And to be fair, like let's say in a 3-4 hour chunk when there's multiple other activities in an AGM, like the founder's on stage for 15, maybe 20 minutes. And so it's not that much time. And sometimes I've seen some AGMs where it's just a fireside chat that the GP has with the founder on stage. With a little bit of a presentation, there's some materials that are there, but really it's just like a conversation that they have. And let's be honest, 15 to 20 minutes for a fireside chat is not that much time.
But I think, when a founder gets on stage, I'm looking at her, is she impressive?
Yeah.
Can she sell? Does she know her market?
Mm-hmm.
And can she give market insight and talk about notes from the field? And can I learn something about that product and that market I didn't know before?
Yeah.
And do I think there's an exciting opportunity? Right. I'm not typically I'm not looking to that person to show me their forward financial results and us to dig in.
Yeah.
Right. That's
not
their job in a group setting. And also that's not the founder's job.
Yeah.
The founder's job is to do that in the board meeting or in the small meeting with the GPs.
And let's say, how much of that actually comes out in the stage time and how much of that comes out with the founder, at least, where you just like after all of it, the networking section, so to speak, that you just go directly to the founder and be like, hey, you know what? I'd love to ask you a couple questions. I'd love to hear more about what you're building. How much of that comes in offstage conversations versus onstage conversations?
I would try and do it on the onstage.
Yeah.
For example, there could be a great founder that if I don't need to take their time, I won't. Right. I believe and it comes from being a founder that, every minute I'm not serving my employees or customers, I'm not accruing value. Yeah. Right. So empathetically, I'm not going to just ask questions to ask questions. Right.
Yeah. Do you typically use, and I know about this from others, but do you typically use like AGM time to catch up with other LPs in the room? Like just what their market sentiment is? Or how do you, in the networking time, how do you primarily use your time there?
Well, to your point, the first is there a direct investment I want to make? So then I am very focused. Secondly, this is the time where I can, really get some banter with the GPs and ask follow-up questions. And I know they're busy, but they also are ready, where they know all day today is LP conversation.
Yeah.
I typically, so there is a really good amount of time. Then of course, right, there's notes from the field from LPs. Typically, I run into people I know and like, and we make a time to follow up, right? Since they typically also have an agenda that they're trying to accomplish, right? So it's usually like the reminder that we need to catch up.
That totally makes sense. And so for you, at least, is there a good co-investment? Take note of that, go back to your team after, it's like, hey, this might be an interesting co-investment. For others, it can be market sentiment catching up, or is it worth like having a re-up decision in this fund if this is getting closer to the fundraise schedule?
Definitely. I think you're trying to get a flavor for what are the tenets of the firm and where is it going in that re-up decision.
And it's so hard to fortune tell in full transparency. And no one has a crystal ball. I actually sat down with a CIO of a large pension the other day, and we're just talking about like, it's kind of is our job to fortune tell, but it's so hard to do so, especially with so much volatility. And going back to what you mentioned, like even per industry, there's so many micro tectonic shifts that make it really interesting to track. And, technological shifts, political regulatory shifts, cultural shifts, a lot of these things happen when in full transparency, when we least expect it.
In all this, I always go back to my tenets of venture.
Yeah.
It's backing great people, attacking large markets at low entry prices.
Yeah.
Right. That has never changed. Right. And anytime we have like, late stage venture is the new best thing. It always falls back to there's market, but low entry price, great companies, like that always works out. Right. And so I think a lot of it is coming back to you could fortune tell on the margin, and maybe there's, maybe you should put a little bit less money at this year, but you're not course correcting for the tenets of the asset class.
Totally. All right. Adam, you and I, we can chat forever. We have our first caller in, so I thought it might be helpful to just let Carmen in.
Hi.
Carmen, what's up?
How are
Have you guys met before?
I don't think so.
First time.
Nice to meet you.
This world is both a small world and a large world at the same time. And I constantly remind me of it because in many ways I'm like, oh, of course Adam and Carmen would eventually have met. But sometimes you're like, maybe they haven't. Also for the fact that both of you are very different geographies. Well, Carmen, welcome. And thanks for taking this time to jump on with us, share a little bit more about Coco, and also ask your questions. So maybe to start things off, could you tell Adam, as well as our audience, a little bit more about what you're doing at Coco?
I'm Carmen, a VC turned angel and the founder of Cocoa. At Cocoa, we back killers with a heart at pre-seed seed, investing $500K angel checks and bringing all my VC network and VC insights to support founders as their in-house VC and help them hack the system. That's what we like to say.
And you're reminding me already because the last time we caught up at Dandelion Chocolate, I called it Coco VC and she's like, no, it's Cocoa. And I'm like, damn it.
I'm not annoying about that. Is whatever way people want to pronounce it, I'm happy with.
I failed as a host in the very first minute already. So I hope you can forgive me.
It's totally flat. I'm lucky that you brought us together and that you have me here.
I love it. Thank you for being here. And I don't think the viewers and listeners can tell, but at least when we're recording this, you, on top of having your name Carmen, you have an emoji of a chocolate bar right next to it, which is so representative of what you're building as well. Also, some of the coolest swag as well.
Which you have waiting for you at Comptons on Fillmore.
I do. Oh my God. Okay. You can't tell people this. We're recording them. Somebody's gonna go there before me and get that. So
there's lots of Cocoa merch at Comptons on Fillmore with Bush.
Okay. I gotta run. This is where people hang out. Adam, this is for you as well. I know you're in Atlanta, but when you come to San Francisco, this is where you go. Carmen, you have a question for us, which is a really thoughtful question as well. And so what is the question? How can Adam help?
Super. Okay, so I'm very excited to meet you. I find your background super, super interesting. And in these crazy times that we're in, I was thinking, what's a belief about venture that you have held firmly for years and that has now changed? And you have changed your mind about it? And what was the trigger for that change of mind?
The first is I was a believer in high entry ownership, right? And I was a believer in super concentration. And both of those came from the typical venture model around you back a company, it goes public, it's worth 2 to 3 billion, right? What's changed is the outcomes have gotten bigger, which 5% of OpenAI looks pretty good. And complementary capital, right, works. So I have relaxed my requirement around being a lead investor. That said, I've not relaxed my requirement around earning the right to be a lead investor. As an entrepreneur, I had 17 VCs. I am references for 3. So I want VCs that back companies with high NPS scores, regardless of the ownership you get.
How do you assess if a GP has a high NPS score? Like, what are the questions you would ask in references or otherwise to understand that?
I'll give. What's fun is a lot of times it's not the question you ask, but the behavior of the reference call. I had a person take a phone call within a CEO of a very hot company, take a reference call within 24 hours on their honeymoon. I got on the phone. I said, we probably don't need to talk at all. The fact that we're on the phone is the reference, right? You don't do that unless that person's gone to bat for you.
Yeah.
So true.
And then it's really instantiating why, if someone is good, why are they good? And going back to hearing specific examples and stories versus they're good and then they can't explain why, right? Because no one's incented to give a bad reference.
Carmen, for you, how do you pick which references go on your on-sheet reference list for LPs?
This is a very good question. Also because I've realized I've just fundraised Cocoa too, and it like the outcome is really positive. And looking back at what happened, like how it was, it's like hard work plus everybody's support plus good luck, and that everybody's support component is so critical. I honestly try to be as honest and open as possible, so I don't have like sort of closed lists. There's the full list of cocoa companies. Of course, I provide the contacts to make it easier for LPs to reach out. But and likewise with VCs. But in my role, I encourage like LPs to speak up, like to speak to anybody in the ecosystem. And every time I think there's follow-up question to this, which is interesting, is people really want to be helpful, and so they ping me always. I'm like, what would you want us to say? Like we have this reference. Like what would you want us to say? And I always say honestly, like whatever you think. Like it's like whatever you think will be the right thing that they should know. Because at the end of the day, I also want to partner with LPs who come into Cocoa to knowing everything. You know, like having a real picture. If we're gonna work together and build an authentic relationship, like they should know all the things. So that's a little bit how I manage it. And then I made personalized chocolate for people as a thank you for being my reference.
I'm so curious for that personalized chocolate, just scratching my own itch here. What is on that personalized chocolate?
What it says?
Yeah, what it says.
So it just says like, it actually said, it was a bit of a joke, but would you be my reference? You know, like, would you be my someone? That's would you be my reference? And then there was cocoa. And then like, as always does, by the way, if anybody wants the hack, it's done with Tony Chocolates. It's like very easy to like kind of design the wrapper, and the chocolate is really nice. And then on the edges, you can put like sentences or whatever you want. And I have this sentence from the movie Wonka that says, it's not the chocolate that matters, it's who you share it with. And that goes into all of our personalized chocolates.
This is probably the elephant in the room. And Adam, let me know if you have follow-up questions here. But I know this because you told me this last time at Dandelion. Why is your firm called Cocoa?
So my firm is called Cocoa because when I started Cocoa, and Adam, something you said is really resonated with me around the ownership, because Cocoa is built around this idea from a fund economics perspective that stake is relative to size. And therefore that you can have small ownership stakes in absolute matters that allow you to unlock a certain relationship with the founder because you're small on the cap table and still make the fund economics work. And basically I was looking for a name that would be like approachable, but also cool and aspirational. And Cocoa came to me, and I went to a chocolate store to buy for the first LP, whoever commented, a bit of chocolate to just kind of see if he liked the name. And at the counter, there were the faces of making chocolate. It was a really fancy chocolate store. And so they were and then I was like, wait, Cocoa? Like pre-seed, seed, Series A, Series B, Series C is like cocoa is the seed of chocolate. And from the cocoa beans to the chocolate bar, there are many stages, like in the life of a startup. And then I went through a rabbit hole. Making chocolate is actually super difficult. Chocolate has more tasting notes than wine. Like there's so many relations with like craftsmanship, with passion, with excellence in execution that are also required. And then my brand mind, because we build the whole brand in-house, is my guilty pleasure. And just, it has an emoji, it's edible. You know, everybody sort of likes chocolate when you like chocolate, and it's just so playful and memorable, and it brings joy, and it's just so much fun to build a brand around chocolate.
What do you want LPs to know that your superpower of working with is founders, that you do better than anyone?
100%. And that's, by the way, Cocoa being a small fund, that's what I'm very like laser focused on because my resources are limited. So I always say I want to do on the cap table what nobody else can do, right? And that nobody else can do is a combo of three things, which is an angel check plus angel ownership stake. So my position in the cap table, plus I was a VC for 7 years before launching Cocoa. So I know in large funds. So VC network plus VC insights. I know every VC for sure in Europe, a lot in the US. I know how they think, I know how they work, I know what they optimize for, plus EQ. And I say that's kind of the equation I always tell founders, and it's a function of my experience being small in the cap table and EQ. And I just want to be that in-house VC, that trusted confidant, and that helps them hack the system.
What beyond other LP introductions do you want from your LPs?
Oh, that is such a good question because I literally just jumped off it. David knows this, but of my first LPAC for Cocoa like 15 minutes ago. And actually, it's interesting because the primary thing, even before introductions to other LPs, and I've been very lucky that they've made the introductions and that completed the LP base, but I want thought partners, like brain partners. I think that, so I'm a solo GP, and also I know that the one key thing that I lack, especially in fund building and kind of strategy, is the perspective of time. I think that the beauty of LPs is that they've seen a lot and across different models as well. And I just want brain partners that can like bring in that experience and those insights that I might, not know what I don't know, and create that sort of relationship that is like radical honesty, radical transparency, so that they can ask me the right questions, get me thinking into the right terms, because it's quite lonely. Cocoa is both the joy of my life and the hardest thing I've ever done. But it's a lonely place. Like it's a lonely place to be the founder of a company. To be the founder, solo GP in a fund is a lonely place. And so I like to have my LPAC as part of my team.
This is fascinating stuff. I also want to be cognizant of time. Carmen, thank you so much for the question and sharing. So helpful. I love your energy every single time we chat. And if viewers and listeners couldn't tell already, you're the kind of person that's going to go very, very far, and you're a joy to be around. So thank you.
Thank you so much. Likewise, right back at you. And Adam, thank you so much also for taking the time to asking the questions. I hope that we can meet in person, spend lots of time in the US, and hope to see you around. And I promise to bring the chocolate.
Wonderful to meet you, Carmen.
Bye. Have fun, guys. Thank you for having me. Bye-bye.
So you asked a really interesting question to Carmen earlier, which was, what do you hope to get from your LPs outside of LP introductions? What are some of the answers or examples of answers that you've gotten to date?
It's a great question, and it's all across the board.
Yeah.
That I don't think the LPAC is a great, it's like I typically try and build things that are 75% to 90% baked before to the LPAC. Right. My thought partners are the LPAC members, but maybe the small conversations.
Right.
Right. I think getting a first response to something, whether it be we're planning to do an SPV or we want to do an opportunity fund or we have an investment that might be controversial, getting three main people's live take. I think it really is the preview before you put something into motion, fully into motion. Because when you announce something and you send it to 50 LPs, the last thing you want is uproar. You kind of want to be a lawyer and ask questions you already know the answer to.
That makes sense. And when you say live take, meaning when people hear it on the LPAC, they hear it for the first time. Because I also know, and the reason I asked that question is, I also know there are certain GPs who have a pretty robust LPAC where they would chat with one or two champions first and get their raw take before they even bring it to the LPAC. Is that a usual practice that you see?
It depends how controversial it is, right? Yes, if it's something as important as raising your next fund or a changing strategy.
Yeah.
You should have the small meetings, but then they also want to be in the room all together and you want consensus of going forward, right? Where they also see the other peers are in favor of it as well.
That makes a lot of sense. And so what are examples of, you mentioned a couple in terms of controversial decisions. A, pivoting fund strategy. That's a controversial decision. B, at the top of my head, I'm imagining like changing the partnership, whether that's demoting someone, whether someone is leaving, or what are the optics around like changing the partnership in and of itself, or like changing one of the partners or one of the, there's that. 3, extending the term of the fund. Like instead of like 10 plus 1 plus 1, it's like, can we add an additional 3 years because things are taking longer? Those are examples in my mind of controversial decisions. Am I missing anything else?
I mean, those are three that count, right? I think, adding an opportunity fund, right? Doing something that will take extra time, right? In there, I think it is sound practice to talk individually with each one, let it sit, and then having a ratification and a summary on the LPAC makes a lot of sense.
Gotcha.
Right?
So it's
you
kind of like
want the LPAC to be like, we agree versus what do we think?
Yeah. Which is probably like, the individual catch-ups. The one-on-one is like, hey, we plan to do this thing. I don't need an answer from you now, but I want to seed it in your mind before the day of our LPAC so we can actually discuss it live and you're not hearing it for the first time. So interesting. So much to think about as well, because this just goes on and shows the complexity of being a fund manager rather than just an investor, right? That's where the difference comes in.
And it really is, it's your product, right?
Yeah.
The difference is your product doesn't take 1,000 engineering hours to create, but it still is as crafted.
So much to go on. We have our next caller in, so I want to let our next caller in, AJ. AJ, what's up?
Hi, how's it going?
AJ.
It's going well. The sky is up.
Can you give Adam, as well as our audience, a little bit of introduction of what Good Trouble is? Because the question is great.
Absolutely. Well, okay, so AJ Thomas from Good Trouble Ventures. So we invest in the intersection of tech and creativity. And we really believe that there are two levers that influence shifts in culture and economic opportunity. And we want to capture what all of that looks like in the IP content and data space, as well as the creator economy and the platforms and picks and shovels that power that, and in sports and gaming. And so we're really excited about what that's going to do in this next digital transformation that we're going after. So
I've delayed that long enough. You have a question for Adam.
Amazing. Yeah. Just, so putting some pieces here, this is really something I'm really interested in because we are in this process right now. But, what is a blind spot that you see typically in how GPs communicate risk, especially when they're raising from first-time LPs?
I don't think your job is to communicate risk, right? I think similar to a founder where their job is to communicate upside potential, and at worst you can lose 1x. At most, the returns can be inspiring. I think your job is to talk about what can go right, and then what are the inputs required to make it go right. So, for example, if you're saying part of our goal is to be tapped into the best creators of the next 3 years, show me how you will tap into them, and I will assess your probability of being able to be aligned with them, right? Versus we might not be able to get into Mr. Beast, right? I'm going to assess that on my own. I think there should be no surprises, but paint a picture and be ready to keep going levels deeper to explain how you're going to accomplish what you're going to accomplish.
I
To
love
play devil's advocate just a little bit here, Adam, clearly you're a seasoned LP. You've done this for a very long time. But I kind of want to emphasize that last part of AJ's question, which is like the first time LP. Would you say the first time LP thinks in the same way of when they're approaching a potential investment opportunity into a fund?
That's also a really great point. Of you have to explain the fundamentals of this investment. That it's a seed stage investment. There is time to liquidity, right? This is how it will behave, right? And I say, especially if they're treating it like an angel investor, and then 2 years later, they're asking for their money back.
The return.
Or, hey, it's marked at 1.4. Can I get it? Right? So I think you have to explain, here is how seed venture fund investing works and what to expect.
And so maybe it's that framing, I don't know if this is the right framing, feel free to push back on this, of here are all the reasons why venture, like seed stage venture is really exciting. But at the same time, if you're a first time LP, here are all the reasons you shouldn't invest in seed stage venture. Long liquidity cycles, let's be real here, it's like 12 to 15 year funds at this point. You're probably not gonna yes, you might get early DPI at like year 8, year 10 kind of thing. But the truth is you're probably not gonna get much of it. Things are less obvious in the beginning. I feel free to fill in the blank for other things that seed stage venture is less than desirable for.
Agreed. Right. I think you want to have a common expectations, right?
Yeah.
So rather than, hey, here's what to expect.
Okay. Well, thank you for that. I mean, I think that first time LP is really the key because, I mean, and I don't know in your experience, maybe if I could just ask one more follow-up question for
By all
Adam,
means.
David, if you're okay with that. And I love how it says asking dumb questions. I think I should put that on my side. For that first-time LP, are you typically seeing first-time LPs coming from that angel space, or are they coming from very more institutional backgrounds and then creating a way in which they're marking their own path around what they feel is a good investment to make?
Yeah, and it's a really great point and discussion. The other thing is to listen and what are they trying to accomplish. So the first answer question, the other place they're coming from is they just had a liquidity event, right?
Yeah.
And so they were running a business in a different industry, sold it, and now have been looking at venture and want to get involved, right? And so you can ask them, hey, what are you trying to accomplish with this investment? And then also saying like, hey, as David mentioned, venture shouldn't, it's risky for it to be 90% of your portfolio, right? At an endowment, it's 20 to 25%, right? So explaining, hey, here's how other investors think about venture. It's a good conversation to have with them, and it builds a ton of trust, right?
That's great. Yeah. Trust is huge in this industry.
So
Thank you
the lesson
much.
here is don't sell it to a first time LP. You just help them educate them on understanding.
Educate each other.
Yeah. And after that, then after they go like, actually, like, despite you telling me all of this is still interesting to me. Then it's like, all right, so what buckets are the most interesting? Is the creator economy, sports, gaming actually an interesting sector for you to get involved in? What outside of monetary gain, what do you hope to access outside of that as well?
Yeah. It's
What
that
what did
golden
that what
circle.
was prompted by that question? What were you feeling like, hey, I'm talking to this first time LP and I feel like they're not understanding it,
Yeah.
or
Yeah, well, I think I'm seeing a lot in the conversations that we've had and conversations I've had with other GPs as well. We're seeing a lot of founders that have had the exits that are coming in and wanting to build, get into that space, right? And be an investor in a very different way because now they're on the other side of the coin, right? And so what I think is really interesting there is there's maybe some bias around how am I going to protect my first time investment? What does that actually look like for me? Am I even going to play in this market? So there's a lot of this trying to figure out what they are optimizing for because they're also not clear because they're testing the markets as well. So that was kind of the prompt of, as a first time LP, is there some sort of framework that, there is a general framework around it, or does everyone kind of have their own personal perspective on how they form what that looks like for them when they're first time investing?
it's a great point, right? And that's where it's hard for you to get inside their brain. It's very easy for you to explain how you think this investment will behave, right? You're not getting your money back next week, right? Things like that. It'll take a little bit for the business metrics to grow and for things to work,
Yeah.
right? All those things.
And you generally feel like you then, as you're, having these conversations, going into sell mode versus the building trust mode. And so that's why it's just a little bit interesting around what questions should we be asking? Should we be communicating risk? Because, if we absolve all of that, then it's off to the races, right? But to your point, is it even the right sector they should be investing in, right? They don't know sometimes. They're probably testing that. So that's
Well,
what
I
prompted it.
think it's your job to it's your job to convey why they should be in creator, right?
Yep.
It's not your job to say whether or not they should be in creator. Hopefully they're just so excited about it. It is your job to say, here is how a seed
Here's
stage
why.
venture fund performs.
Yeah. Yeah. Love that. Thank you.
Spitballing here and also riffing on this conversation so far. A question to both of you. Is there a difference between how you approach the conversation if that first time LP reached out to you first versus you reach out to that first time LP?
What do you think, AJ?
I mean, I think I won't know if there's a difference until maybe 2 questions in. I like to really come in with a point of view of curiosity around why we're having the conversation in the first place. Of course, it's always easier when it's the LP that's approached you.
Yeah.
And so you're already disarmed. But when you're approaching, I think there should always be some sort of anchoring as to why you're having the conversation in the first place. And then you kind of have those decision trees to go off of based on the conversation. I mean, I think it is trust-based when it comes to that. And I've had conversations with LPs before where, like I said, they don't even know anything about the creator market. But the fact that they see what that opportunity looks like based on our expertise and what we know and all of those things through natural conversation and curiosity around what they're optimizing for, that typically turns into a really fantastic conversation. But I would hope, at least for me personally, I like to come in with, either way, I'm going to come in as this, and then I'm going to maintain that curiosity and kind of chaos pilot my way through the conversation.
It's one of the things from this discussion reflecting, it's the bulk of your conversations with an LP happen, -6 months to time and investment. The most important conversations we have with the LP are year 2 through 6 of your investment, right? So we're going to be talking 9 years from now, right? So to shortchange anything on entry is doing both people a disservice, right?
Absolutely. Yeah. I mean, it's that trust building season at those very first conversations, right? And I think having that that compassion for both ends is super important, especially in a space where somebody doesn't know one thing about what you're working on, and then you also don't know what they're optimizing for. So it's really those pieces. But I love your point on that because, yeah, it is a marriage. So how are you going to be celebrating your 10-year anniversary in 9.5 years? On 2 separate islands? I don't know. I hope
Totally.
not.
I mean, it's also using that same framework. It's actually really interesting that you're describing it as the bulk of your conversations are negative 6 months prior to the commitment. The most important conversations are years between years 2 and 6. And I think a lot about this in terms of like the marriage dating analogy, which is year 1 is always honeymoon stage, and you're like, I love you, you love me, I will die for you kind of thing. Year 2, once the butterflies settle just a little bit, you actually start to have some of those tougher conversations of like, where are our expectations for where this relationship is going to go? And sometimes, barring kind of the honeymoon stage, like you might have different sets of expectations, even that you didn't know yourself. And that's when push comes to shove, it's like, hey, like, what are we actually expecting out of this? But if you can weather, let's say, this years 2 to 6, like there's a good chance they'll be with you for a long term.
Yeah. Could I offer a question? Another question, if it permits. I'm a big proponent of the trust equation. I think maybe you both know about the trust equation, but I think about it as an investor. I think about it as a talent person. I think about it as a parent. And it's really interesting because it goes like this: it's trust equals credibility, reliability, and intimacy. And the dividing factor of building that trust is whether or not you feel that self-orientation is only geared for the other person's agenda, or it's actually something that you're co-creating together. So even when I'm approaching conversations with an LP, I mean, you can look them up online, you can look them up on PitchBook, you get all of the things, you've seen their track record in investment, credibility is there. Maybe the reliability you're establishing in the middle of the conversation, where you're seeing kind of, if you have a really high say-do ratio, right? And that's really fantastic in those important, years in those conversations you were just talking about, Adam. And then the intimacy piece is like having the ability to tell you when something's not good, and also tell you when things are great, but not being too high or too low. And then that self-orientation is really being curious around, how is this forwarding your agenda? And how is this also going to co-create forwarding my agenda and the investments that we're trying to make? And so I think for me, when I think about the point of view of coming in with that, it's typically my specific framework as a GP, just because I think it's very human, because that trust factor is so important at the negative 6 months, all the way down to the 9 to 10 years where you're like, what is the return? What's happening in this space? So I don't know. I just love your thoughts around what that cooks up for you.
It's really, I think it's all, I think it's a great framework, right? I think a lot of people, at some point, you're going to need to scale that, right? So how do you scale that with updates, quarterly updates,
Data.
or things that just where they can digest it and understand, right? So I think how do you do that in a scalable way is kind of going to be the main task at hand as you grow the firm.
I love that.
Actually, on that note of like, how do you scale it? Actually, this is the first time I've ever heard the trust equation. I now love it, and I'm going to use it every single time now. But in that thread of credibility, reliability, intimacy, I think credibility might be the easiest to scale because that's like insight development, right? It's like you naturally accumulate more achievements. Exactly. Yeah. Reliability can be built into a system, a process of just like, am I sending regularly quarterly updates? Is there a system for this, right? And have I trained my teammates to also follow this system religiously? I actually think intimacy might be the hardest to scale over time, especially as you scale the team, the firm, more LPs, and all that kind of stuff. And that, I think, helps. And we actually, Adam and I were talking about like, re-up decisions and all that before you came on, AJ. But I think that is what helps determine whether an LP is going to re-up in you or not.
Mm-hmm. Mm-hmm. That is true. And I think that intimacy can be boosted by the self-orientation bit.
Yeah.
Because that's all that you can rise the credibility, reliability, and intimacy in many ways, but that dividing factor of self-orientation whether we're in this together still, or I'm just in it for my bag, helps you have the hard conversations. And I think it is going to be hard to scale. And how do you do that now with a bunch of agents trying to scale stuff for you? Anyway, that's a whole other topic.
That's a topic for another day, a very long discussion there.
Very long discussion.
Yeah. AJ, thank you so much. Thank you for bringing your questions. Your many good questions. Hopefully Adam answered your question.
Oh yeah. Yeah. I love it. I mean, it all just comes back down to that trust bit. What are they optimizing for also? Being curious. That's really it. Thank you so much, Adam.
That's what it is.
That's fantastic.
Thank you, AJ.
Thank you so much.
Thank you, David.
Thanks a lot.
All right. See you later.
Take care.
Bye.
The trust, I don't know, like Adam, have you heard that trust equation before? Because I'll be honest, like I haven't.
I've not. I need to bring it home. It's great.
I need to work into my own rotation now that I know that this exists.
100%.
Do you think there are other factors to the trust equation? Just spitballing here, right? Are there other things we're missing that those three variables don't fully encapsulate?
No, but I think to AJ's point, like doubling down on the intimacy, because I think at the large scale, a lot of LPs are driven by, do I feel personally connected to this person?
Yeah.
Do I believe in this person? And do I want them to win?
Mm-hmm.
And when you're sitting there with 100 LPs thinking about how you scale that, I don't know it's a tough thing to tackle and very worth tackling.
It is different. What have been some of the, let's say, your personal favorite practices on how fund managers have built trust with you?
I think it really comes down to breaking down a company in a very intellectually honest way, because it shows all three things. Where it's not, again, you're not saying here's all the risks. Here are all the things I'm thinking about.
Right.
And when you do that in a very thoughtful way, it builds a lot of trust. And it also shows you're deep in what the most thing that matters, which is picking great companies and having them work.
Yeah.
Right? I think, I aspire to have, kumbaya, like personal relationships. I also recognize that, people have kids, right? And so having 10 one-on-one dinners, right? That's not, that's tough, right? But when the chips are down, you say, hey, I really need to talk to you about something, and getting an honest take. That builds a lot of trust.
I think so too. It's also like, I'm reminded of what you mentioned earlier in our conversation with Doug Dyer in chapter 1, which is and maybe this is a credibility and also reliability, but also you mentioned how Doug breaks down the company from a financial perspective is a really interesting assessment on how they look at companies in general.
Yeah, he's also a CFO, right?
Yeah.
So I think you're going to get a different perspective.
Everyone should lean into their strengths. So there's not one right way per se. How do you think about, for you, and I have this question often for GPs, but for you as an LP, how often do you keep in touch with your GPs? Do you have a framework for thinking about how often you stay in touch with them?
Right now it's quarterly.
Okay.
That's kind of like quarterly cadence. There's a lot of small conversations, but I make sure at least once a quarter.
Mm-hmm.
I think I try to be very empathetic in letting my GPs run. And then when it's time, when I need to talk to them that day or in the next 24 hours, they're not thinking like we just talked all the time about general stuff. Yeah. I also am like very focused on, if I can read something before making you talk to me, I will do that.
Gotcha.
Right? When can I do homework versus taking up your time?
Is it often? Because every GP has their own way of doing things. Not everyone sends quarterly updates. Some do it annually, especially the more established ones, they do it annually. Some of the emerging ones during fundraising cycles, they do it every week or every month, and that's a little bit more frequent. How, like, if you don't get any materials, when you do catch up with them every quarter, what kind of reading do you do?
I'm getting updates from every every
Oh,
quarter.
okay. So it's just like
The
you
emerging manager, I'm
self-selected
getting
yourself
quarterly
into
updates. Yeah.
that. Okay.
But I had a situation where I set my quarterly catch up and then I got the update and I canceled it for them. So hey, that was great. I don't need to take up your time. Right.
Yeah.
And be like, good. Like, listen, we're good. I'm not going to just get on the phone just to kill time.
Yeah.
Right. And check the box.
Everyone's important. Everyone has a family, as you mentioned. Anyways, we have our final caller in the room. And so I want to let Danielle in. Danielle, what's up?
Everything is up today.
Everything is up. I do want to preface with, before I let Danielle introduce herself as well as 1517, I met Danielle very, very, very early on in my venture career. When I still don't know a lot of things. I, as my subtitle says, asking dumb questions. That's what I live for. But I knew even less when I first jumped in. And Danielle was very instructive and helpful for how to think through investments, venture as a whole. And also, she's just fun to be around. Like, Danielle is like a bundle of energy. Anyways, that's my preface for Danielle. But for those who are unfamiliar with Danielle in 1517, Danielle, tell us about you.
So in this day, in this moment, I'm having my overnight success that took 15 years to build moment over Twitter. So it's been a positively overwhelming day. But I was on the founding team of the Teal Fellowship between 2010 and 2015, building that program, working with some of the very known tech greats of today, like Vitalik Buterin and Dylan Field from Figma, who IPO'd last week, which is huge to see. Based on all those learnings from the fellowship days, we repackaged the fellowship as a venture fund. We said we could scale what we're doing 10 years ago. So that's why we started our venture capital fund 1517 that follows that mission of backing people without a college degree. And we have a carve out for backing people who may have a degree but are working on sci-fi tech. So they have to make our dropouts proud and be working on the cutting edge otherwise. But that's how I'm spending a lot of my time these days.
And for those unfamiliar, why that permutation of numbers?
Oh, yes. Yeah, sometimes people are funny. They're like, is it 15 to 17-year-olds? And I'm like, no, that year is the Protestant Reformation. A large institution, the Catholic Church, was saying, to get into the kingdom of heaven, you have to buy this very expensive piece of paper. Martin Luther protested that with his 95 Theses. It was also the more mass adoption of the printing press. And so then everyone could have their own relationship through the technology of the printing press, and have a Bible in their own home kind of thing. And, I'm not a religious person, but the parallel is that today there's another institution, higher ed, that says you can't call yourself an educated person unless you have this very expensive piece of paper. And, we've been sort of spearheading against that charge. We even have our own 95 Theses we wrote in 2017. And we just say it was bullshit then, in 1517 is bullshit now. And the cost of college has continued to go up and up and up and up. We were on the USC campus recently, and it's either like $96,000 or $98,000 a year.
Holy
so
cow.
Thinking about potentially coming out with $500,000 in debt going to school, it's just highway robbery.
I love the thesis that you guys stand for. I also know that you brought a question for Adam here. What is that
Yes.
question?
Yeah. So I'm an educator at heart. And so when we work with our founders, we're often thinking about what's the way we're thinking about the world and trying to translate that to them. And what I've always wanted on the LP side is LPs who can share their view about where they think the world is and where they think the world is going and how that frames how they think about the GPs they invest in. I'd be really curious about sort of your model for how you think about these things and how that model has changed and evolved over time.
That's a great question. And I think the best LPs at the largest stages are thinking in macroeconomic terms, right? And so they are thinking about interest rates and about China and about world order. Getting it from that level down to investing in a $50 million fund, there's a lot of steps. and many times very cognitive breaks, right? Of saying, hey, the interest rate fluctuation, therefore I'm backing off early stage. Like that's confident and wrong, right? Like, like they're and tried to time based on the macro. So for expecting LPs to operate at such a high level, they're really only thinking at most around what's my venture budget this year. Like that's as deep as they're going, right? But then you have lots of people are saying, okay, within venture, what are the things I like and don't like, right? And it's always colored by their background and their past successes, just like a GP, right? And so I think I was mentioning with David, I was a founder, I was an angel investor, I was a Series A investor, and I was a growth investor. And from all of that, I come from backing great people, attacking large markets at low entry prices. Like that will never change, right? Maybe other things will get better, right? But that's still really good. And so that's my kind of world order. And also consistency. That everyone who said I knew 2009 was the right time to put money in is wrong, right? But what you shouldn't do is, it's scary, let me stop, right? So I think that is, those are my tenets, driven by, I think, my background, right? And everyone has different, right?
It's actually really interesting on that. We talked about this earlier in our conversation as well, which is great founders, big markets, low entry prices. I imagine thematically great founders, large markets still stay relatively consistent across eras, but low entry prices probably change out of the three, in my opinion, like the most across different generations. How do you define low entry prices?
I think I define it as 2 years from now, what's the step up? That's one easy one, because that defines, because if it could be too pre and it stays too pre, that's not that helpful, right? So but then also that's probably what do I think the accumulation of value is, and the expected appreciation. And I think we are being thrown curveballs by the speed of appreciation of Anthropic and OpenAI and Anduril. That's not, these are unique companies, right? So the idea that a growth investment quadruples in a year is not driven by business metrics, right? But a seed stage investment can quadruple in 2 years, driven by business metrics.
And it also sounds like one of the things that you're tracking are these new markets that are emerging. How do you think about up and coming trends?
It's a great question. And one of the things is at Emory, I learned a lot from Srini, the CIO, around tracking everything, but being slow to deploy, which was not my natural inclination, but it's the exact right move for a forever institution, right? If you catch crypto year 5 versus year 1, the endowment moves on, right? And I think that's really sage perspective. That's really hard to find in the heat of fervor, right? In these new markets, I go back to the business fundamentals, right? To find out if there's a there there, right? And the customer concentration, the robustness of, is it a horizontal, is it a product that is kind of no chance, not downside protected, but just has so much market adoption that it's not going to go away, right?
This reminds me quite a bit. We had Bryn Hobart, the economist, come and speak and actually give a workshop at 1517. And he said something that really stuck with me and made me think about, especially sort of like hot or emerging markets in a different way, is he said, when something is getting really heated, it's a great time to learn because so many people are working in something. And to your point that you made, it might not be meaning that you should also hotly be putting capital in, but it's a great way to be able to educate on an up and coming system. And it was interesting because I think my attitude before hearing that from him used to be almost more like annoyance, like, oh, everyone's in this new hot thing and here we go. And then as taking his frame, I was like, oh no, okay, this is a great way to learn about, a space before it is sort of platformed.
Yeah, like two great, exactly adding on to that. One, I should never be taking market risk. I should not be betting in a venture fund, not sure if the market will produce outlier companies or enough outlier companies. That's just not what I should be doing. Now, one of my GPs should take market risk, right? But not at a fund investment level.
Right.
That's the first thing. And the second is to your exact point. Like last night, I was looking at the weekly active usage of ChatGPT, right? So how do you sift through in the hype? When Facebook, it was daily active users, right? How do you, and in these AI companies, it's churn metrics. So when there is hype, how do you look at metrics that can't be hyped?
Right.
Right.
Mm-hmm. One thing that you just said also made me want to ask another question, which is about portfolio construction. So, on our GP side, obviously, we're thinking a lot about portfolio construction and where we're taking risk and things like that. How do you think about portfolio construction as an LP?
I think 80% should be on thesis and 20% should be you couldn't sleep at night if you didn't do it.
And is 20% the upper limit, or is that like a soft average, so to speak? Like if it's 25%,
I think that's upper limit, because more than that, it's scope creep, right?
Yeah, right. It means you should be rethinking your thesis.
That makes sense. We actually had a discussion, actually very similar to this one earlier, where I think it's not a public episode, where we talk like 10% being the feels right to most LPs, but 20% being the upper cap as well. I've obviously heard different perspectives over time, so just curious on that. But I like the framing of 20%, you can't sleep if you didn't do it.
Mm-hmm. Mm-hmm.
Did that answer your question on portfolio construction for you, Danielle?
I think so. I mean, and the first part of like being in thesis answers a lot of it.
Yeah.
I think a lot of the LPs that I've talked to, like part of their thesis is super early risky, seed and earlier investors, but then they, part of that thesis is also balancing it out with the growth funds and things like that. So it just depends on what your thesis is. But we believe very similar things at 1517 of that you have a thesis and you stick to it. In fact, it's been interesting when we've, gotten to know LPs and things like that. And I'll never forget, I think this was in our fund too. Someone asked us like, what percentage of dropouts do we back? And I said, it's about 85% dropouts, maybe 15% thesis breakers in terms of the sci-fi people. And the LP was like, oh, wow, you guys actually stick to your thesis. And I was like, isn't that what I'm supposed to do? And I, having not worked at another venture capital fund, I didn't know how often it is that just the whole thing is sort of, well, we're opportunistic. We just kind of do whatever looks good that comes to us. And I think having that thesis is very clarifying for the type of work any of us do.
And there's a real interesting push and pull where, I think specialists, and this is something I still haven't figured out the answer to, that a specialist, there's some quotes that are, in order to get to fund 3, you need to go from specialist to generalist, right? Or there, and I don't know if I believe that, but I get it, right? I
Mhm.
think, if you extricate, I am backing people that I think are N of one people at low entry price with non-traditional backgrounds.
Yeah.
Right. Like then, that's that's still on thesis, right?
Mhm. Mhm.
I think like something that Adam mentioned earlier, which is as an LP, your job isn't to take market risk, but as a GP, you can have creativity within kind of certain boundaries. Like Danielle, you started doing this like 15 years back, like you mentioned earlier.
Mhm.
And 15 years back, I imagine the thesis of investing in dropouts was very arcane. And
Sure.
Adam, I guess maybe from your perspective, if you were to rewind yourself 15 years back, would Danielle's thesis be the equivalent of market risk because it was so early and so unproven? Obviously now you've gotten Figma, you've gotten like, Ethereum and all that, but then would that count as market risk for you, Adam?
It's a great question where, I'd want to see good examples and I'd want to see a robust pipeline.
Yeah.
Right.
Yeah.
Versus if it was like, hey, Mark Zuckerberg did it and that's it. Like, I'm like, great. Like, so your job is to catch the one person a year. But when it's like, hey, we got 150 people applied or we've interacted with, here's what the pipeline looks like. Here's the quality of the work that's being done. And it also speaks to, for most emerging managers, the one and done close is over. Like, so why don't we lean into it? And I'm doing a talk actually the week of Raise on fundraising, where showing what you're going to do as part of your fundraise in a more instantiated way should be part of your fundraise, not just idea of like, hey, I'll close everything in one and done, and then I'll go to invest. I think that's very few funds are have that right now, right? So just lean into it, be like, hey, here's 6 examples. For example, I'm coming into fund 1 where I think there's like team and market risk, but then over 9 months, he's made 6 investments. So that's de-risked, right? I get it now, right?
And when we were first getting started with 15, 17, 10 years ago, we did exactly what you're talking about, Adam. We had a whole slide that was, hey, if these had been investments instead of a grant of 100K into these Teal Fellow companies, here's what they would, and we called it our hypothetical track record. We said, this is what these would be worth right now. Like, this would be the proof in the pudding. And I'm forever thankful to our 30 LPs who backed us in Fund 1, because they were the true believers. Like, we didn't have a data room because there was no data and all of these things. But to your point, like, we had to show, hey, this is this pipeline, this is this community we've built, this is the access, and here's how deal flow comes out of that. And here's the types of outcomes that we're anticipating.
Freaking love it. This is, Danielle, this is why I love you and all that you stand for at 1517. I want to be cognizant of time. So thank you so much for the questions.
Thanks for hitting me.
And we'll see you soon.
Yeah. It was a great conversation today.
Great.
Super
Thanks,
fun.
Danielle.
You must be on your high. So I'll let you get back to like responding to everyone on Twitter who's coming your way.
I am very positively overwhelmed and still overwhelmed.
Best kind of overwhelming to get.
Exactly. Thank you both.
Adam, as we round the bend here, and we've had 3 incredible GPs call in, you've given a lot of advice to, Carmen, AJ, and Danielle. For the audience at Broad, is there one last piece of advice you'd give to either the GPs listening to this or the emerging LPs listening to this? Any piece of advice?
Well, I think the first thing, is it goes both ways. Of the GPs, be exactly who you are, and stand by your thesis. And then for the LPs from that first conversation, know how the conversation you're having fits into your overall investment framework, right? That What are you trying to accomplish? And you could be open. I think with with Carmen, she's looking for LPs to explain what they're looking for from this type of partnership. So feel free to, there's a lot of people don't share. They first don't define, and secondly, don't share. I'd encourage people to share more of saying, hey, what would be, if I invested in you, what would be if everything goes right, what would I expect? And brainstorm with the GP. I know the GPs, so many GPs talk about lack of transparency. I think there's real opportunity for LPs to share more. And I think Carmen touched on it, and I think it's a real opportunity.
I love it. I love it. Before we do the curtain call, Adam, what's going on in your life that maybe the audience should be aware of? And if they want to track the amazing things you're doing, where should they look?
So first is Akkadian.vc, where things are rocking. We are investing out of multiple funds and really committed to creative venture capital at all stages. And we now have strategies at all stages of the venture ecosystem. I am always looking for great managers. I'm always looking for great companies to invest in. And on October 23rd, we have the 2025 Raise Conference, which we are the stewards of, and Ben Black's the co-founder of. It's in San Francisco. We had 940 small funds apply, and expect 100 selected to be announced soon. It's just going to be a great day, and it's turning into the most productive day for both GPs and LPs interested in emerging venture capital.
Adam, thank you so much. This is super fun.
Fantastic. Thanks for having me.
Let me know down in the comments or on socials if we should do more of these.
I hope you enjoyed today's episode with the one and only Adam, and I highly recommend checking out his earlier episode on Superclusters. In fact, here's one of my favorite moments from our episode in season 4.
The platform you're trying to work through from in your OKRs.
Mm-hmm.
So I'm a big believer in OKRs. I think, and I feel like people should behave rationally. And so figuring out what are the rational drivers of things. And for Emory, it's a forever institution. Their Utopia is doing 12% IRR every year for 90 years. Like, that means everything's well funded. And like, the ship is secure, right? Protect the base. They're serving a university and a hospital system, having cash on hand. So their forever institutions is the number one priority. So venture is like the niche high octane portion of the endowment. And then co-invest is even the more nichier high octane. And so I was trying to underwrite a 5X with an upside, but feel good about a 5X, not a 10X, not a 20X, on a company that we feel already hit product market fit, that wasn't going to have too many shocks to the system along the way, where things were kind of humming versus 2 to 3 pivots from victory.
Gotcha. And when you co-invest, this might be a pretty dumb question, so call me out on my rookiness if so. Was it to double down on maybe a fund manager's pro rata rights, or was it just a net new commitment into a company that we were trying to build a relationship from scratch?
It's the first thing. And also, I have a different filter and goal at Akkadian, but they're a lot of the same tenets. To answer your question, if I was seeing a deal net new, why am I so lucky? So it's about places where we thought we had information and relationship advantages. And
that probably bleeds into, you've talked to them maybe at AGMs or otherwise at events. You've seen it in reports of how they've been growing. And at some point you're like, this makes a lot of sense for us to pull the trigger.
I'll give examples. Netscope, 4 years of watching them execute. Very obvious. Applied Intuition, met them at an AGM. very obvious. We should, for an endowment doing co-invests, you should never squint.
Hey Superclusters fans, David from Post here. If you enjoyed today's episode, all I ask are two small things. One, there's a little red subscribe button down there if you're on YouTube, and a follow button if you're on Spotify or Apple Podcasts. If and only if you enjoyed today's episode, that's the button to click. You'll get many more presents, many more insights, and many more brilliant minds straight through the internet vines just like this one very, very soon. Two, it'd mean a lot to me if you could share it with one other friend who could gain a lot from listening to today's Cosmos of Insights. Also, let me know if there's anything I should have asked down in the comments, and if there's enough interest, we'll have today's guest back for an even spicier part dose. I made a promise to myself to record 100 episodes of Superclusters, so every comment, question, and review helps me make this experience more helpful and fun for you, and makes investing in venture a little less scary and a lot more friendly. And lastly, I wanted to share a quick disclaimer. The views expressed in this podcast are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of any organization that we're a part of. None of the views expressed herein constitute legal, investment, business, or tax advice. Any allusions or references to funds or companies are purely for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor prior to making any investment decisions. And that's all from me. I'll see you in the next.